Hello everyone, this is Troy Eckard with Eckard Land and Acquisition here in Allen, Texas. This is part of a sequence of educating our mineral owners on specific parts of the mineral rights ownership that may or may not be clear to everyone. And today we're going to be talking about decline curves. Now, when you buy minerals, you don't really have to worry about production, you don't have to worry about operations, you don't have to worry about decline curves because essentially we've got multi-billion-dollar companies that are doing all the work, hiring all the engineers. They're day-to-day managing our assets for us. But because the decline curves in a well affects our revenue, and because those decline curves essentially are part of the efficient draining of the reserves in the ground that belong underneath the minerals that we own, it's important to know what takes place and why. So let me give you an example. What I've drawn on the board for you up here is this is a starting point of where a well might initially come in producing. So it's the initial rate of flow when a well is first turned on. That flow rate can vary. The flow rates used to be, let's say 20 years ago before horizontal drilling, was down here at between, let's say, 50 and 100 barrels of oil a day equivalent. Okay? That was a good vertical well. And that vertical well would produce, and it would be almost economically drilled in probably less than 7 to 8 years. We were on a treadmill. Wells would come in like a 16-ounce Coke, supercharged, you perforate the pipe and make hole. In the pipe, 6,000 to 7,000 feet deep, all of a sudden the well flows. It comes on and like a 16-ounce Coke, it drains very quickly because there wasn't a lot of quantity. Then we started improving by drilling deeper wells using 3D seismic. And then all of a sudden we started seeing production rates come up here where maybe we started seeing 300 to 400 barrels per oil per day. And of course, obviously, much, much better than 50 barrels a day. And those decline curves would start doing like this, but they would still die somewhere between 7 and 10 years. Why? It was the type of formation. It was sand. It was conventional reservoirs. And so you didn't have this really compacted fossil fuels. What you had was a buried river channel, maybe a buried lake. Maybe you had this sand deposit that created all the trap for the organic materials in place. And once you punched a hole into it, well, guess what? That hole depleted. And when it depleted, these wells went away. And you no longer had vertical wells making economic sense because, one, we couldn't find them very successfully. And the second part of that is they didn't last very long. The U.S. oil and gas industry was on a treadmill. Now, you and I own mineral rights in non-conventional reservoirs, which are thick and they're organically rich. Some of the most rich organic material reservoirs on the planet is in shale formations. The problem was it didn't have porosity and it didn't have permeability. You need those two things for molecules to flow. The more pore spaces you have in the rock, the more it acts like a cavern. It holds more molecules in place. And then the permeability is for those rock or reservoir content to be able to connect the pore spaces so it flows from one pore to the next. Non-conventional reservoirs like shale formations don't have very good connectivity or permeability. So what we've been able to do is over time we've been able to improve the ability to stimulate those non-permeable reservoirs by artificially fracking them. And that fracture is probably the equivalent, in my view, for a simple analogy, is taking a 3-liter Coke, shaking it like crazy, over-pressurizing it so it's ready just to bust loose. And every time we've improved the fracking process, the initial flow rate has gotten higher and higher and higher. Now there's two components to that initial flow rate getting higher that are beneficial to us as mineral owners. Number one, the higher the rate, the more oil and gas they're going to produce in the first 3 years. Why is that important? The oil companies who have leased our minerals are effectively saying, how do we take $500 million, invest in drilling, and what's the quickest way to get a recovery of that $500 million so I can go out and drill more wells and compound my revenue and compound my reserve base and continue to grow my company. Because of frac stimulation, they're able to get out in 2 or 3 years what used to take 7 or 10 years. That's really important. The second part of that is because the flow rate is higher, it usually means the decline curve will be longer and further stretched out over time than if you start with a low rate. Let's just do it kind of simple. If this is where we frack today and the well came in at 400 barrels a day, that means the reservoir, the fractures within the reservoir had a certain limitation how far they went out, how much artificial permeability they created. And so this well might be a great well, and it starts off, and this is what it looked like. Maybe after 15 years, that well's been depleted. Much better than vertical wells, but this is kind of what we were looking at 7 to 10 years ago when we call it vintage wells. They started out here, they produced, by the time they got out to well number 14, they're making 50 barrels a day, maybe even 25 barrels a day. That's about all they were producing at this point. And the oil company says our expenses are more than the production revenue. By increasing the fracking, increasing the stimulation, we've now increased the initial flow rate, which has now given us a much longer life of well. It's given us access to much more reserves, and it's given us the ability to recover our investment capital much sooner. So I've given you a highlight up here in the green, and the green is essentially saying all the money the oil company, our lessee, our tenant, that they've invested in that well, they hope to get it back inside of 36 months. Now, when I take a look at you and I investing in minerals, I'm going to get a check. So check number one, first check down here, is going to be based on what? Probably the first 1 to 3 months worth of cash flow. I'm going to get check number one. It's going to be a good check when those wells finally come into pay, usually about 6 months after start. The second check that I get is only going to be for a single month. But now I'm going to get that check every single month going forward for the next year. And so it depends on how this well is declining. Wells decline because just like that 3-liter Coke, once you take the pressure, the carbonation out of it, it still has the same content. It just doesn't come out as with robust extraction rates because the pressure is less. The same thing with your reservoir. Now you and I should not care, and I don't care, because here's what I like. If I can get a well to start at this point of initial production, and I can get my lessee, the person spending 100% of the money, taking all the risk, and I can see them getting all their money back in 36 months, not only have they recovered, let's just say, 200,000 barrels of oil equivalent in 36 months or less, they've made their money back, which encourages them to do what? Now they're going to come drill wells number 2, 3, 4, and 5, because they've already built the pad site, the electricity, the power line, the water line. They've got the infrastructure in place. Now they look at the financial results of well number 1 and say, let's go drill 2, 3, 4, and 5 because the reservoir is so thick. I want you to know this decline curve conversation is important for multiple reasons. Let me give you the first one. You need to know why your initial check from any first or initial production off of any wells in your minerals is always going to be higher. That's the first production. It takes 3 or 4 revenue cycles for the oil company to sell the oil, get their first check, process it, make sure the ownership deck's correct, they finally send the check out. It usually is 1, 2, 3, 5 months worth of production at one time. Your next check after that from those same wells is going to be for a single month. Mathematically, it's going to be 1/3 if you have a 3-month distribution. If it's 6 months, it's going to be 1/6. Don't be alarmed by it. Be grateful for it, because what you've done is captured a lot more revenue much faster. The second part of understanding this decline curve and part of this educational process is that you have probably 500,000 to 1.5 million barrels of oil equivalent per well drilled. That's the economics that these oil companies are drilling off of. If I get 200,000 barrels in the first 36 months, and I still got 300,000 barrels to 1.2 million, 1.3 million barrels left, I really don't care, because I've made back probably most, if not all, of my money in the first 36 months, just like the oil company. But here's the difference. When that well finally reaches a hyperbolic decline curve and it levels off, it now reaches a point of just complete continuous draining, and they're predicting these wells could last 50 to 75 years. The higher we start, the more gradual we fall. The higher we start, the more connectivity we made in the reservoir, the more access to the reserves, the more successful we have in a higher percentage of drainage of the reservoir. So to you, to me, to all of us as mineral owners, just bear in mind one thing. If you could put $1 million to work for you today and generate a return of that $1 million in, let's say, 36 or 48 months, and you have a revenue source with no financial obligation, no holding cost, no capital cost, and it can generate free cash flow for 50 plus years, name one investment, one asset class that even comes close to matching that. I challenge you, because there's not one that exists. So when you start to realize the decline curve is actually a huge advantage for us, it's not a negative that your wells are declining, it's a positive that they're starting with such a high rate, returning so much capital, rewarding our lessee, rewarding us as mineral owners, and providing us with hundreds of income-producing assets with zero liability, zero holding costs, and cash flow for up to 50 plus years. Hey, I'm Troy Eckard with Eckard Land and Acquisition. I hope this explains the decline curve and what goes on behind the scenes and why decline curves really are a positive to me, not a negative, because I want all that money up front, just like you. Thanks.